Hi, everyone. Welcome. I'm glad you can join us this evening. I'm Dove Sachs. I'm the interim director of the Institute of Brown for Environment and Society. We've got an exciting event for you tonight, and I'm glad you can join us. This is actually the third in our public events in our series on environment and society. I'm just going to tell you a few brief things about the Institute. IBIS is an institute at Brown that's focused on research and teaching with the goal of helping to solve the world's most pressing environmental problems. We have three world-class strengths. One's around climate change and threats to biodiversity. One's around climate change and really the melting Arctic and the rising seas. And the third is really around climate misinformation, how misinformation campaigns are funded, and informing climate policy. And it's in that last context that I'm particularly excited by the group that we've assembled tonight. Clearly, we need to make more progress on enacting effective policy. And I think, at IBIS, we're really interested in finding the most useful tools. And it seems that finance is a tool that has been underemphasized in academic and I think also in policy circles. So I'm really excited about tonight's discussion. Tonight's discussion is organized and hosted by a Brown alum, Ricardo Bayón. Ricardo is an amazing individual, very talented and accomplished, working at the interface of environment and finance. He's like an A+ alumni. He's actually teaching a course for Brown this spring semester on environment and finance, and it's going amazingly well. I'm super excited about it. And he's also graciously agreed to host tonight's event. So I'm going to turn it over to Ricardo. Thank you very much.
Thank you, Dove. So as Dove said, my name is Ricardo Bayón. I'm a partner and founder at a group called Encourage Capital. And Encourage is an impact investment firm headquartered in New York, but I'm on the West Coast. And the way we work is we try to find investments that are both good investments, i.e. provide a return on investment, but that are also good for society and good for the planet. And we've done investments in climate and carbon, investments in solar energy, investments in a number of different things. And we've looked at issues like plastics, regenerative agriculture, water. But the subject we're going to talk about today is very near and dear to my heart because it is really about how finance can play a role in addressing the climate problems. And is it playing a role, and how could it play a role if it isn't, and how could we do more if it is? And we have a stellar group of panelists to talk about that. From a variety of different perspectives, from a variety of different parts of the climate finance value chain, if you will. So private equity, banking, business, as well as sort of observer NGO side of the field, and the academic research as well. So before we get into the discussion, and we'll have time for questions at the end, I'd just like to have the panelists introduce themselves. Maybe we can start with at least the way I have it on my screen. Julie, why don't you go first?
Hi, Julie Davids. I'm head of Impact Solutions for BNP Paribas. And Impact Solutions basically means addressing both philanthropic capital and for-profit capital for our wealth management clients.
Thank you. Lila?
Hello, everybody. Lila Preston. I'm a partner at Generation Investment Management, where I head up our growth equity fund, which is where we're investing in private companies, really driving the transition to a more sustainable economy. And we at Generation manage money across public and private with about $30 billion, dedicated wholly, entirely, and always to sustainability.
Thanks so much. Jeff.
Hi, I'm Jeff Colgan. I'm an associate professor here at Brown University in political science, and newly the director of the Climate Solutions Lab at the Watson Institute, which is our public and international affairs institute. And I have an engineering background a long time ago, but now very much focused on kind of international political economy of climate change.
And Mark.
Hi, I'm Mark Campinali. I'm the chair of the Carbon Tracker Initiative, which is a non-profit financial think tank. Employs about 30 staff in London and the US. Prior to that, I spent 20 years in sustainable fund management, and I still keep my hand in private markets deals in regenerative agriculture and renewable energy.
Thank you, Mark. Rodrigo?
Hey everyone, nice to join you. I'm Rodrigo Prudencio. I'm part of Amazon's corporate development team. Was a founder or on the founding team of our newly created Climate Pledge Fund, which is a $2 billion or initial $2 billion commitment from our balance sheet to invest in startups that can help Amazon go faster towards its net zero carbon pledge, which is to be net zero carbon as a company across all of our operations by 2040, 10 years ahead of the climate pledge or the Paris commitment. Nice to be with you all.
Thank you, Rodrigo. Maybe we'll turn first to you, Jeff. I mean, what we're seeing out there right now, I would characterize as the most movement in my memory around climate that I've ever seen, right? And I've been working on climate and carbon issues for about 20, 30 years. But the amount of interest, the amount of movement we're seeing, and the amount of interest in carbon markets and the development of carbon markets is impressive. And it kind of comes on the heels of a time period where it felt like nothing was really moving. And certainly, you know, on the policy front, it kind of felt like governments had not really wrapped their minds around what needed to happen if we were going to reach sort of the targets of, you know, 1.5 degree change, which we've probably already blown beyond, and we will never reach it. But, you know, keeping it within non-catastrophic levels, let's say, and at that time, I started seeing a tremendous amount of movement from the financial world. So new products, new interest, and, you know, this year marks the sort of second year we've had Larry Fink, the chairman of the biggest asset management firm in the world, sort of put out in his letters that he wants to take climate seriously, that Blackrock will take climate seriously, that it will invest with climate. And, you know, this kind of came in a steady barrage of announcements and interest from the financial sector. And so hence the title of this talk, which we may or may not agree with, which is finance stepping into a gap left by policy on climate? You're watching both policy and finance. I wonder what your take is on that.
Yeah, thanks so much. I mean, I think what's happening right now in the finance sector on climate change is super exciting. It's amazing to see the figures of, you know, in sustainable investment, you know, up by 50% over in 2020 over the last 4 years. The amount of investment associated with ESG, right, environmental, social, and governance criteria is doubled in 4 years, tripled in 8 years. Just extraordinary explosion. And I think you're right that it is related to both failures, but also some successes that we're coming out of, right? So the failures are very much there. That, you know, I'm old enough to have watched this for about 30 years now of, you know, in the 90s, especially, and in the 2000s, where there was a mindset around let's treat greenhouse gas emissions like we've treated other kinds of air pollution. We'll do cap and trade, we'll do carbon pricing, carbon taxes of some kind, and push on that. And we'll do sort of an interstate agreement like the Kyoto Protocol that will be our solution. And that has not worked well, if we're honest about it, right? That yes, there's a Paris Agreement, but it is very weak. We're in a world where every nation on Earth could be consistent with its nationally determined commitments under Paris, and we still don't solve the problem, right? That climate change still gets quite a bit worse. And many countries have adopted some version of carbon pricing, but the United States is not one of them, and the prospects for that don't look good either. So there is a sense in which, you know, this is a much bigger problem now today, and so finance is responding to the reality of what's happening, but it's also responding to some successes, and in particular, the one that I would really point out as instrumental is sort of the success in the costs of solar and wind energy generation, power generation, have come down really dramatically in that same time period. And that matters a lot, and it matters for two reasons. It matters because, of course, suddenly the economics of an energy transition are feasible, and there's now a real potential to say, okay, we're going to move from a fossil fuel based world to a world that's renewable in terms of energy generation, not just for electricity, but potentially for transportation, lots of other things as well. So that represents, if you're an investment person, that's a huge financial opportunity to try to say what's the infrastructure and all of the business that comes associated with that. And so I think that's where we see the finance sector getting excited. But the second really big reason that this matters is not just in terms of the renewables themselves, but there's sort of a demonstration effect going on where if we believe that, yeah, okay, that cost curve came way down over time for solar and wind, well, maybe the same thing could happen for battery technology and for sustainable aviation fuels and for maybe hydrogen, possibly, and maybe even carbon capture and storage as a technology. And so there's a narrative here about the kind of future that we should expect. And crucially, that narrative is competitive because China, we watched over the last 20 years, become the world leader in solar and wind energy manufacturing. Coming from a level of like 1% of the market in 2000 to like 2/3 of it today. So a tremendous shift. And you can see kind of many in the West, right, in North America and Europe, that are responding to that and thinking, okay, we might already be too far behind on those technologies, but what are the next technologies we need to get ahead on? How can we be the leaders on a next set of industries? And that, again, sort of fires up investors.
Yeah, and it's also a little bit of a mind shift that we've seen happen, right? I mean, I think people are starting to take it more seriously. The wildfires in California and Australia and the Amazon, I think people are starting to feel the effects kind of sooner than even some of the worst scenarios we're saying. And so I think people are changing their tune in lots of different ways. And at the same time, we've also seen this growth of interest in ESG, right? Environmental, social, and governance, and taking those factors into account with investing. I mean, we're seeing the European Union basically come out with a sustainable financial disclosure regulation, which is going to affect not just European companies, but pretty much every major company that wants an investment firm that wants to, raise capital in Europe or do business in Europe. And it feels like finally we're starting to wrap our brains around this concept of how do we internalize the externalities and how does policy force disclosure, but not just, what is the pull for that disclosure, right? The customers, investors, and others saying, I want an ESG option. I want to know what you're investing in. I want to know what sort of investments are happening. And that ties into that whole climate science side, right? So it's both the technology drivers, but also a mindset shift, it feels like.
Absolutely. Absolutely. And it's not, as you say, it's not just the investment flows, it's also new policies, new accounting standards, new, financial risk modeling, new, ways of thinking about insurance. So there's just sort of a proliferation of what's going on in the last few years. Mark Carney being part of that, but lots of other things going on as well.
Right. Thanks. Rodrigo, you and I are veterans of the old carbon wars and have the scars to prove it. We've seen version 1 of the carbon market, version 2 of the carbon market. Maybe this is version 3 of the carbon markets that's emerging. And you've looked at this from, investments in technology, from renewables. You've seen this path that Jeff described. I wonder if you can comment on this. First of all, tell us a little bit about what you're doing at Amazon, but also comment on the evolution and what you've seen happening and where you think we are today.
Sure, with pleasure. I think, well, first, again, just to expand the description of what we're doing at Amazon, we made a very public commitment in 2020 to, in 2019 to first publish what our carbon footprint was, but then importantly, give the whole company a target of where we wanted to go. And that was a really important commitment that Jeff drove and really filtered all the way through the company. And as a result, almost every operational team at Amazon has a part of the climate footprint that they own to contribute to the whole rolled up progress that we need to make as a company to effectively set ourselves on a path to and reach our net carbon zero commitment by 2040. The role we play is in making investments in outside companies, acknowledging that we're not going to invent our way internally out of things that frankly are being done better by outside companies. A really great example and a very visible one is the large investment we've made in Rivian, which is now responsible for the production of an initial order of 100,000 delivery vans that are now starting to roll in different parts of the country as we test it out in new environments, where we're starting to deliver packages with electric powered Rivian vans, which are powered by renewable energy, which by 2025 will be 100% renewable across all of our operations. So, and this is just one place though that we have to decarbonize our operations. Obviously, there's much tougher to do in other places like aviation, but there we have made an investment from our Climate Pledge Fund in a company called Zero Avia, which is just one again of many solutions that I think we're going to have to invest in and work on to keep advancing the presence of new technology that ultimately Amazon can use, but hopefully in Amazon being a user of this technology or the solutions that these companies are working on can also be an indicator to a much larger market need, which we hope to then promote or not necessarily promote, but sort of provide an example of how these technologies can operate at scale. For me, just to kind of jump on Jeff's really good, concise history of what was happening, I've sort of helped. I've taken a way of describing this to people as, and when I think also about the kinds of commitments that companies like Amazon and other large corporations have made over the years. There was a time when companies first started talking about their carbon footprint and just the carbon footprint management or measurement and declaring sort of what their number was kind of the first step that many companies took, but they never gave themselves a target. They just said, this is what we emit. And the science of what companies were emitting, both directly and indirectly through the different scopes that are used to measure this stuff, is even now still evolving, but it was at least a first crude attempt at giving companies an idea and giving the public an idea of what companies were emitting. And if, again, just to wind back the history a little bit, the SEC, even in the early years of the first Obama administration, the first 4 years, was proposing the idea that companies were going to have to declare their exposure to climate risk. And that rule never went anywhere, but it sort of set a bunch of companies to the attention of, well, we better start understanding where our measurement and footprint is, et cetera. I think the next phase we saw a bunch of companies take, again, not uniformly across all of their products and certainly not across all companies, but companies then started also making commitments about taking carbon out of certain products or reformulating products to be more environmentally friendly, more sustainable, better sourcing, more sourcing through supply chain integrity. And so that started to address pieces of what companies offered in the market. And then lastly, I think the phase that we're entering into now and is indicative not only of Amazon's commitment, but so many others, is companies are now saying, well, we are going to be held responsible to getting to a certain point in a timeline of when we need to be, as a company, carbon neutral or negative carbon, to the extent that some of the tech companies are doing that as well, Google and Microsoft leading the way there. So I think that it's a really interesting evolution, but the most important one that's happening now, and I think part of what is also a positive pull on new technologies for adoption here is the fact that companies themselves are saying we need to be customers because we are now committing ourselves to a certain outcome that we believe we need to see.
Mm-hmm. And what role do you think finance has played? Because you straddle these two worlds, right? You're in Amazon, but you're in a part of Amazon that's investing in other companies. How have you seen finance evolve? And do you buy the title of this talk that finance is stepping into the gap left by policy, or do you think it's more complicated than that?
Yeah, I don't think policy, I mean, I can give you one example of where policy has pushed us to have to innovate faster. We deliver packages all across Europe as well as we do in North America. But in Europe, there's about 20 municipalities and over, I think, 220 zones in those municipalities that restrict our ability to drive an internal combustion engine van to deliver packages. So policy, just as one example, right? Policy has actually limited us in terms of our operations. And so we've had to look at that and say, well, we better start accelerating the path towards zero emission deliveries. And we are working with electric vans in Europe. We're working with bicycle couriers in Europe. We've innovated to react to that. But Amazon also famously tries not to be a reactive company. It tries to sort of think ahead and look ahead and have a bias for advanced action. I think that this fund and our climate commitment sort of encompasses a much bigger idea there. I think the role that finance is playing is both in the piece that we're doing here on a corporate level. Lila can talk more about what the team at Generation has done. I also want to point out that we're living through a historically low cost of capital, period of low cost of capital. That, along with product maturity, technology maturity, has meant that the underwriting by debt markets, which is the cheapest sources of capital, for the proliferation of wind, solar, batteries, electric vehicles now, probably electric vehicle charging, anything that might be debt financed that spreads that transformation, the electrification of everything, is in a massive advanced wave right now. And a lot of that is driven because we're at a historical point. So maybe it's a lucky thing right now, but we're at a historical point of low cost of capital. And that, with technology maturity, I think is a really, really powerful factor in the market.
Yeah. Thanks, Rodrigo. I might turn to you, Julie, as working in a bank, one of the banks that has kind of led the charge on addressing climate. I wonder if you could tell us how BNP Bank of the West has approached the climate challenge, what you're doing, and then, kind of take a step back and tell us what you've seen happen in the world of finance and banking over the last couple of years in terms of climate, and how the thought has evolved and where you think it's headed.
Thanks. I absolutely think, and I know that BNP feels that banking is a key lever in the climate evolution and energy transition. And I think there are two different parts of the story. First is banking in general, as we're looking at North America, banking has finally taken a serious look at systemic risk. And it took big expenses to hit for that to happen. Morgan Stanley, I think they measured between 2016 and 2018's 650 billion cost of climate damage in that 2-year period. Those are factors that really get banks to step up and pay attention. But then just a couple of years ago, when Blackrock, joined the Climate Action 100, that was another really big change, I think, in the banking sector. And now today, we have something like 45% of assets, AUM, directed towards sustainable finance, and leading that is Blackrock and Vanguard and State Street. So the banking sector as a whole, definitely moving in this direction, whereas before they had been neutral, if not negative. I think on the energy transition and climate change. And just today, in fact, I listened to Larry Fink was speaking with Bill Gates, and Larry Fink was really passionate about not only divesting but investing. And he was really waving the flag about how much capital is out there and that we have to get it moving into renewables. So that was really exciting. On the other side, we've got BNP Paribas, which is the 8th largest private bank in the world, based in Paris. They have been looking at what I call this optimistic capitalism for decades. And they have built in this risk and opportunity measure long before North American banks started this. So it's really exciting. I mean, BNP has been looking at this with a systemic lens, with a societal lens, and really hoping for more collaboration, but also recognizing that this can't happen overnight and taking a lot of heat about the fact that it can't happen overnight. So what we have done around climate, and we have many other pillars of social efforts, but around climate, we have aligned in 4 specific ways with the Paris Agreement, and that combined with the UN PRIs and the UN Principles for Responsible Banking, that really is the foundation of our actions now. So the 4 main components are ceasing financing of the dirtiest forms of energy extraction. And the bank also really looks to leverage the full weight of asset management and commercial banking around policy change to move markets. We work with energy companies and help them transition to sustainability, and we have 3 specific paths to that transition. And then lastly, we have tools that are proprietary and others to track the progress. And BNP really started this back in 2003 and has been ramping up ever since. So there are kind of 2 sides to the story. Interesting, and what Rodrigo said, of course, what's happening in Europe is different than what's happening here in the US.
Mm. Yeah, and I mean, one interesting aspect of what BNP has done is that, you basically publicly said that you're not going to finance some of the dirtiest industries, or if there's no move to transition, right? And that probably meant a hit of several million, maybe $1 billion.
And had a lot of zeros on there, yeah.
Tell us about that. How did that come about, and was that difficult to do?
It was incredibly difficult, but it came about really through Paris when the bank looked at risks, physical risks and assets. They felt, taking a long-term view on sustainability, there was no choice, that they really needed to start making this move away from the dirtiest and most extractive fossil fuels. When the bank did that, there was a big blowback, both in PR and in loss of business. But the bank has determined that it will be better for their financial health in the long run to exit fossil fuels. So it's been very difficult. We've lost some very big clients over this decision. But I think what's important for investors and just all of us who use banks, we need to understand that where your money sits actually it does affect this energy transition. And so BNP is really trying to move the needle and push people to look at their assets, where their assets are, and BNP has looked very carefully at where their own principal sits.
Yeah, it's sometimes hard because people don't pay attention to, where their money sits and how it's invested. And I think that's been an interesting radical shift. And we've also seen tremendous innovation in tools available to finance in this space, right? You know, we've seen the rise of green bonds, finally kind of reaching a sort of $1 trillion level. Now we have sustainability linked bonds, which are fascinating, right? Where basically the interest rate of these bonds is linked to some sort of outcome. And for the first time ever this past year, sustainability linked bonds had more issuance than green bonds, you know, largely as a result of COVID. There was a bunch of sustainability linked bonds tied to COVID. But you can imagine a future where, you know, if you emit, you have a higher interest rate, and where you emit less, you have a lower interest rate and a lower cost of capital. And we are already seeing that world in lots of other ways, but this just kind of makes it clear. I wonder if you have any thoughts on the innovation that's going on in the financial space.
And I can only speak to banks. Banks are incredibly constricted, but I think that these new disclosure rules will actually be great, because that way there's a financial incentive to be more creative around these tools like sustainability linked loans and other types of bonds. We're doing a lot of structured notes that are focused on the environment. We're doing we're launching a big fund, the Global Fund for Coral Reefs, for example, which is looking at touching on every livelihood that is associated in any way with ocean health. So, and this is a hybrid fund. So we're going to be looking at deploying philanthropic capital and for-profit investments specifically to social entrepreneurs through this fund. And BNP has several other hybrid funds similar to this, and they've all been very successful. So I think this goes to show the appetite is there, and even within constraints of a banking field, there can be some innovation. It goes back though to risk, and banks are risk averse. That is in their DNA. So the more we can de-risk the innovation, I believe, and a lot of that can be done through philanthropic dollars. I think that's a big marker for us if we can keep moving forward with these hybrid approaches. Yeah,
I guess a risk-taking bank is sort of like an innovative accountant. You know, you don't want too much of that.
Exactly.
Great, Lila. I want to turn to you. I mean, I think this point that Julie touches on is fundamental, right? I think, you know, if you characterize the last 3 decades as a world where finance has kind of wrapped its mind around risk, how we measure it, how we price it, how you trade on it, how you use it to hedge, I think maybe the next couple of centuries are going to be about internalizing these externalities, including carbon and others, as a form of risk and risk management, but also as a form of opportunity development, as sort of Rodrigo was hinting at and Jeff were hinting at. And can you tell us a little bit about Generation, the work you do there, and how Generation sees this from the perspective of an asset manager that manages different types of portfolios out in the world?
Absolutely. And I think this is to underscore where Jeff started with some of these data points around the momentum that we're seeing today. It is true. It feels different. Probably all of us have been doing this work for 20 plus years, Ricardo 30, probably. I've known many of you at least half that long. So it's noticeable that many more people are at the party as of 2020 than there were, a long time ago. But it's important. And I think just like one example is we were helping to stand up the Net Zero Asset Managers Alliance. This is something that is articulating the commitment of asset managers to net zero by 2050. Generation has its own target for 2040. And as last I checked, because it is a moving target, there's 73 signatories, $32 trillion of assets under management. And this is an initiative that we kind of helped working with others to bring into place in the past 6 months. I mean, there are many, many other initiatives, CDP being one of them, the Carbon Disclosure Project, which probably took a decade to get to that level of participation and support. So obviously things are happening faster. And one of Vice President Gore's favorite quotes is from the economist Rudy Dornbush, which says things take longer than you think they will and then happen faster than you thought they could. And I think we're here now. Really importantly, I think it's like, you can't just jump in and be proficient. You have to either look towards examples of learnings on, where people have potentially overstretched, or where finance has gotten a little over exuberant around trends, and make sure that we do it right. So like doing it right this time and being coordinated, because there's a lot of people who have that expertise, and these cost down curves for technology, disruption, not just in solar and wind, but, battery costs, genetic sequencing, compute power, just on and on and on. We've also got change shift in consumer demand. We certainly have appetite for better products and services that bake sustainability into the total value proposition. Regulatory tailwinds, sort of like the eradication of the internal combustion engine in something like 20 countries by 2050. I mean, this is meaningful momentum that's taking place, and I think then you're starting to see flows of capital and then innovation. So this is not the cautionary tale moment. This is actually, like, let's make sure that we, work together faster than ever. I would say we do equity. So we do public equity and private equity. So we are equity investors. That is very different from credit or structured debt. There's a whole host of tools that are needed in the tool belt, but we do think that incremental to, public private equity, that there's a need for climate transition financing. So really filling the gap and making sure that people understand that as a kind of a layer of kind of financial tooling that's going to be needed in addition to everything that we do in our day jobs anyways. So that's one active dialogue. And then I would say making sure that within any investment, you ask the question of what the company does and how the company operates. And I just think of sustainability on those levels of, as this company grows or this asset, expands, what are the products and services that it delivers? And how do you link that to a net zero, prosperous, healthy, safe future society? Like, we should be able to answer those questions. And I would suggest that responsible finance should have an ability to then track performance over time on the what. And then the how is, okay, there's then an engine room of operations. Sometimes it's a company, sometimes it's a facility. So let's look at the supply chain management, the culture, the people, the diversity of the decision-making body, governance controls, and all of that, kind of, I say base ESG, or just like kind of that hygiene layer where you can get more insight into how this entity operates. And if you can optimize sustainability on both the what towards ultimately, sustainable development goals, net zero future, and the how, in terms of best in practice ESG, like we're going to get somewhere. And then my final little soapbox point is that, like, all companies have impact, positive and negative. So this is not a discussion for some, this is a discussion for all. And in that context, everyone has to wrap their heads around that, because this is not it's not like only the good companies are going to be sustainably run or impact oriented. And I really think that perhaps, as an ecosystem, we might have been a little exclusive in that kind of first few decades, and now it's time to be inclusive. And I think that's kind of the mantra for the next decade.
Yeah, no, I think one of the trends you mentioned is about, how do you know all of these things? How do you judge and measure companies against all of these sort of risks and opportunities? And that's where some of this disclosure regulation becomes interesting. And it's not just Europe, New Zealand has said so. We've seen talks amongst various central banks about how they will judge and assess banks in terms of some of these structures. And now in the US, I think we're starting to see the pushback against that kind of disclosure regulation. So Senator Toomey has said this is a backdoor to deal with liberal issues like climate change. You saw a letter from an SEC commissioner, Hester Pierce, the other day, 2 days ago, basically saying, we shouldn't mandate ESG disclosure. This is not what our regulations should do. There's a lot of good reasons why we shouldn't mandate it, and we should continue to stick to our knitting, I'm paraphrasing, and as the SEC focus in on the things that shareholders want, because going to a model of stakeholder capitalism is difficult. How do you look at the coming regulatory tailwinds and the coming regulatory battles on this space?
Well, listen, I think this kind of like the leading corporates, and then I think many of the countries have understood that there is certain best practices, and I think still demonstrating where those best practices lead to competitive advantage is probably still the space that we're in. Will there be regulation in different forms on disclosure? Yes, I mean Mark will jump in, I'm sure, with plenty of his views around that. But let's start with basics. Like everyone should understand there's scope 1, scope 2 emissions, and ultimately scope 3. Like there's certain things that you almost can't argue against. It's just like I always call it somewhat like the hygiene level. I think we should have harmonization of those hygiene levels of what is base information that investors need to make this assessment of risk, return, and impact. So think of that as like the third dimension. So climate and other impacts that we're going to need more information to make those determinations. Again, some people who practice these skills for quite a long time can infer and can make certain, can draw certain conclusions from information that they're given. But let's make sure you get a hygiene layer or requirements. And then upon that, let's compete. And, again, like the best performing companies or teams will want to, pick the key sustainability performance indicators that illustrate how they're contributing towards a solution. They will embed that into their products and services, and then they'll talk about their organization and how they deliver that. And I think then, you'll see that the competition in a good way towards quality, but that's going to take a long time. But let's get in place this base, I think this hygiene layer for disclosure.
I mean, one of the interesting things watching Generation was that when you were born, you were born with this thesis that basically by looking at these other factors at the time, they weren't regulated or mandated or anything like that, but that sustainability factors were going to drive out performance. And that's how you invested. That's how you raised capital. And it seems to have driven out performance. It seems to have played out the way it was supposed to, right? Do you think that's been a beacon for others, or how are you seeing that?
So I can't talk about performance in public forums, but I will say that our belief is it's the very, very best way to manage capital over the long term. And again, my day job is in private equity, so we're backing private companies. These are the innovators and the disruptors who are delivering, I'd say, solutions where we really, truly, have to understand the future that they're underwriting. So as they scale and grow, what is the outcome, and then ultimately what will be the impact on emissions or on financial inclusion or on health outcomes, because we do take a systems lens. Like Generation is a systems thinking organization. We do a ton of roadmap work into the sectors of the economy and how they're shifting. We put out an annual sustainability trends report, which everyone can download, which talks about the 190 charts that we thought told the story about transition and disruption from sustainability across all sectors. And we believe that kind of, we think sharing those insights is really important. So I think that's probably where we want to be distinctively known for that systems view.
Thanks, Lila. Mark, turning to you on your take on all of this. First of all, thank you for staying up late there in London to join us here. I appreciate that. But you've been watching this as long as anyone. You were involved in the finance space. You're now pushing the finance space to be better is the way I would put it, and bringing up some fascinating concepts like stranded assets. And just to summarize, stranded assets says that a lot of the oil that's in the ground will be left in the ground for reasons of climate change and other reasons. And if that's the case, then we need to change the way we value oil companies, because we have historically valued them on those reserves and access to those reserves. And so we're overpricing lots of things in this economy as a result. So it's basically you guys don't understand the impact of externalities here report. But the way you see it, how do you think we're doing? Are we moving in the right direction? Do you buy the title of this talk? Has finance stepped in, or has it not stepped in? And where could it be better?
Well, I've been really enjoying the conversation so far, and the points that Jeff and Rodrigo and Lila have been making that I picked up on is this is a technology-driven clean energy transition. There's no doubt about it. The renewable energy technologies whether it's solar, wind, batteries, or on steep learning curves. And in our assessment at Carbon Tracker, in most parts of the world, renewables are winning purely on an economic basis. It's about 60% of the world's coal fleet is uneconomic. It's actually cheaper to close it down and build completely new renewables with battery storage than to keep operating these coal plants. So in that sense, you know, we're winning the technological battle. The challenge is, can we build out quickly enough? And will the climate challenge get us before we can scale up the cleaner technologies? So I think, and I'm not the only one, a lot of people think in terms of carbon budgets, how much atmospheric CO2 can be released before we exceed warming thresholds of 1.5, then all the way through to 2 degrees, and then 3. We're down to less than 10 years before we create the conditions for 1.5, and maybe another decade after that before 2 degrees of warming, and that's 2 degrees above global average mean temperatures at pre-industrial levels. We've not seen this for hundreds of thousands of years. Have you ever met bankers who think when the Arctic's melted, you can refreeze it? I have.
They're probably out there, right?
It's extraordinary. Because of course, the stability that we've seen in the global weather systems has taken hundreds, tens of thousands, hundreds of thousands of years to stabilize. And this mindset is essentially that, okay, well, look, you know, we can't be too disruptive. You know, we're living in the quote unquote real world. If it takes 30, 40, 50 years, and then we can net everything out in 2050, even if we go through these thresholds. And I think the reality is, once we've actually got to concentrations of CO2 in the atmosphere associated with 2 degrees, it's really, I mean, we're really in grave trouble at that point. And so we have to take a no regrets approach to this. And so that I want to come to your question, which is, can the world of finance displace the need for policy? And the answer for that is clearly no, it can't. What I do think is true, and if you understand the world of power dynamics, I try and do that. You've got a lot of power concentrated in the world of finance, as you have in business. And in many respects, they have both together have a hold over the world of politics and policymakers. And I think it was Bob Dylan, a good American, who once said, money doesn't just talk, it shouts. And at the time in which the world of finance really mobilized over the last sort of 5 years, 10 years, on the side of the climate science, whether it's Blackrock or State Street or BNP Paribas, and of course Generation, I think actually what that did was outmaneuver the world of business when it came to the policy side and the lobby. And policymakers, government were able to turn around and say, look, the owners of these corporations want us to get this stuff done. That was the critical key change, I think, that we saw, certainly at the Paris Agreement, when finance, I was at the Paris Climate Summit, and when finance turned out en masse, was really the time when government and policymakers realized it was time to do something. But if we look at power dynamics, the renewable energy has not mobilized collectively in the way that the fossil fuel industry has mobilized collectively. So I was once in Brussels, I had to go and see some people. I was talking about what we're doing at Carbon Tracker, and he said he wouldn't believe it. There's 800 lobbyists are in the parliament today from one of the oil companies, just one of the oil companies, and they're going around seeing all of the different elected officials. There were just 2 greenies in the building on that day. This is a huge lobby, and the fossil fuel industry is entrenched. A piece of work that we did at Carbon Tracker called The Tale of 2 IPOs. In the last 10 years, there's been 2,500 coal, oil and gas IPOs from global markets and secondary placements that have raised nearly $700 billion versus about 60 billion for renewables. Certainly a big change in the last year with all these electric battery SPACs and so on. But you've got markets which are still open to business for the world of fossil fuels. And inevitably, for all the good things that Blackrock and State Street are doing, because of the world of indices and passive, every large major coal, oil and gas IPO, they're essentially, due to the need to mimic markets, they have to buy these IPOs. So we have a major problem really in the way that, for all this stuff about structure, that financial markets are regulated. And I particularly point to the way stock exchanges, the admissions process, the way prospectuses are put together. So you had 2.5, so we've already got more fossil fuels listed in the world's markets. That's what the unburnable carbon stranded assets thesis came from in our first report back in 2011. So since then, regulators around the world said that 2,500 coal and gas companies should raise capital to build out even more fossil fuel production. It's a kind of form of insanity. And then the passive managers have to buy it all because they feel obliged to replicate the market. Before I stop speaking, I want to turn to some of the points that Julie made about systemic risk and disclosure and corporate accountability. And this goes back to the sort of almost the power question between corporations and finance. The corporations will give you disclosure if you want it. They'll give you hundreds of pages of disclosure. And I tell you now, they're going to wrap you up with all kinds of disclosure. Carbon Tracker, I've got some great team of analysts. We've been looking at the disclosures made by a lot of the fossil fuel companies. And the amazing thing is in their disclosures is it's all pretty much business as usual, of which the world's going to need more fossil fuels is one of the most important things that they're saying. And so the world, as we know, is planning according to looking at what the majors are doing. The coal, oil, and gas majors are planning a huge increase in production of fossil fuels. I mean, it's very clear that their plans are expansionary, even against this backdrop of technology. And there, I think we have the basis for a major systems risk. So if you look at the central bank recovery programs, particularly look at purchasing debt, a lot of it is being buying the debt of fossil fuel companies on a huge multiple of the rest of the market in terms of proportion. We reckon at Carbon Tracker that around half of the world's non-bank credit is linked to the fossil fuel economy, around half. There's around $20 trillion of fixed assets, pipelines, refineries, oil rigs, coal mines, railroads carrying coal, $20 trillion that we're going to have to write down in the next 10 years, 15 years. The banking system is up to its neck in bank lending to the fossil fuel economy. And we have to unpick and unravel that over the next 10 or 15 years. We're nowhere close to being ready to do that. And we don't have actually, looking at disclosure and risk, we don't actually have a system of regulators, no matter all these wonderful announcements from the SEC and the TCFD, that's able to get to grips with the scale of asset write-downs and depreciation that we need to see in the fossil fuel economy to actually get ourselves anywhere close to a banking system that's properly addressing climate change. Debate.
Yeah, I guess what you're pointing to is how intermeshed the financial system is to the fossil fuel industries, and you know how bank IPOs, how lending, and you know people often forget that the debt markets are considerably bigger, maybe 5 times bigger than all equity markets, and the amount of debt going into fossil fuels is probably tremendous. So if you're right on these two theories, i.e. the enmeshment and the stranded assets, then that is a huge systemic risk for our entire financial system as that unravels. I mean, that'll make 2008 seem like a dinner party, right?
Yeah, we think it's about a factor of 4 or 5 relative to 07, 08. There's a very well-known central bank known for its climate expertise, and we had a call with them. There were about 7 or 8 on their side, half a dozen on our side. And we were asking these questions about who within this central bank monitors all of the global issuance of fossil fuel credit within the banking system, within the shadow parallel banking system, in the bond markets. And they said no one is monitoring the global issuance. If you said to them, what's the total outstanding credit in the fossil fuel economy? They don't have that answer. And they actually said, which made me laugh, they said, once we've worked it out, would we mind sharing our findings with them? I don't know about you, I go to
so you're
bed
now an unpaid laborer for the central bank.
I go to bed at night thinking that the central bankers, you know, have this under control, that this is so huge that they know what's going on and they know what they're doing. And but there's no one's job to collect this data. Nobody collects this data. So I mean, so one of the things that we're doing at Carbon Tracker with a US group called Global Energy Monitor, we're building an open and transparent global registry of the world's fossil fuels to look at how much embedded carbon dioxide there is within the projects planned by the fossil fuel majors. So we can say to policymakers and bankers, look, you know, we've already got 4 degrees, 5 degrees of embedded CO2 in projects underway or being scheduled. What's going on that you're banking them and providing even more credit? So this would be a reference point for people to look at and actually see. So one of the things that happens at Carbon Tracker, we do get banks, well-known US banks, calling us up and going through their loan book on oil and gas lending to get our views on which projects will be, in our view, stranded. And we do go into that level of granularity because the banks are, I mean, if you were to Google, if you go away and Google reserves-based lending and climate change, you'll only find one or two reports, one from EBRD, which talks a little bit about our work at Carbon Tracker, but you won't find it. You've got the banks, huge US banks that have massive loan books based on reserves-based lending, which is where an oil company says we've got 1 billion barrels of oil, the price is $60 a barrel, we'll lend you, $3 billion. All that history of banking, traditional banking, we're going to have to rewrite all the rules, and we haven't even started on that. And time, as I said, time is short. I mean, we're down to the last decade if we're serious about the science of 1.5 degrees, and we don't have the banking system ready to get to grips with this.
Yeah. So, I mean, but if all these things are repriced, if people start believing that these are stranded, that has a cascading effect, right? Those reserve-based loans are underwater. All of these things get unwound. I mean, it's incredibly painful, but
well, it happens quickly.
Does it even affect
we saw it with coal. I mean, coal was 3% off its global peak demand, and prices fell by 90% across US stock markets for coal companies. It wasn't like coal demand dropped by 10% and then the US coal stocks fell by 10%, or US coal demand fell by 20% and then stocks fell by 20%. Demand fell by 2%, 3%. The stocks went into bankruptcy, essentially. And that's the wonderful thing about markets, financial markets, is they discount the future and reprice happens not overnight, but relatively quickly. And that's where equity investors in particular get caught short, is because you only need 3-4% of the total shareholder base of a company to start selling, to tip, even for large companies, tip the share price by 20-30%. And it's the phenomenon of margin selling. And this is
something kind of like a version of Lila's quote of that old quip of how did you go bankrupt? Slowly at first and then all at once. That may be happening. But let me put you on the spot, Mark, and then I'll let anybody else from the panel jump in because this is pretty juicy. That's a lot of pessimism right there. Any optimism anywhere?
I started off with the optimism. This is a technology-led revolution. We're scaling.
That was a bait and switch, Mark.
We're scaling the clean technologies. No, I'm a great believer of you have to assemble the facts and do the analysis, and then you get smart people together to examine the facts, and then you decide a plan. And simple point I'm making is there are some basic facts that we don't have answers to yet, such as the total quantum of outstanding credit to the fossil fuel economy, who owns it, whose pension funds are holding this stuff, and the proportion of the business lines of the fossil fuel majors globally, which is still based on expansion, and that has not been properly understood by equity markets. I think it's not so much pessimism. I'm saying, let's get to grips with this and understand it, and then act accordingly. And we're just not there. Anybody that knows me, and we've known each other, I don't know, 20 years, and I've known Lila for 15 years, and so on. So we'll know that I'm inherently an optimist. But what is that phrase about the optimist of the mind and pessimist of the whatever? I'm always going to get that quite wrong, but you know the one I'm talking about. I'm not a pessimist. I just want to make sure that we deal with this within the time that we have, and time is getting short.
Yeah. All right. Anybody want to jump in here? Jeff, go ahead.
Yeah, I wanted to jump in just by saying, I started out by saying that this is like super exciting what's happening here. And I think that it is, and I don't want to recant that at all, but I think there are some questions that we should be asking, some hard questions about what's happening. Obviously, the one that comes up a lot is, how much of this is greenwashing? And so Julie's point that we now have $40 trillion, $45 trillion of assets under management that meet some form of ESG criteria, that starts to beg the question of, well, okay, what does ESG really mean at that point? How much of that is talk versus action? So there's a question there. The second question should be, even for the companies that are more than just talk, how patient should we be with greening companies, right? How long do we want to give the companies to clean up their act, particularly ones that already have something of a track record of promising green things and not delivering? And then on top of that, there is a question for me around, to the extent that there's, energy and excitement about redeploying capital and even divestment, what have you, there is some danger here about redeploying capital from publicly listed, often Western-led companies to opaque markets, or to companies that don't have the same kind of reputational concerns that big publicly listed companies do. And you can see this already, where some mining companies are, selling off their divisions that are digging up coal and various things to these companies that are located in, I'm not going to name names, but in countries that immediately makes me suspect that maybe they're not going to be fully transparent about their activities. And that makes me worry about, are we pushing in the finance sector to a brightly lit, clean room and pushing, all of the dirt under the carpet or wherever, right? And so those questions, I think, should be absolutely on our mind, in addition to the one that Mark asked of just the sheer scale of the problem and the assets associated with the fossil fuel industry. So yeah, I wanted to make sure to put that on the table.
Yeah, and I coined a term for that. I call it carbon laundering, because I think we're going to see a lot of that happening out there in terms of companies kind of cleaning their act by taking some pieces of their operations that are dirty and making them private in some way, shape, or form to have those squeaky clean numbers. Anybody want to comment before we jump into questions from the audience? We have a bunch. Any thoughts? All right, so we'll turn to.
I like Blackrock. I have friends at Blackrock. One of my directors has just gone to work there. But the Blackrock Energy Transition Fund, am I right? Did anyone notice Exxon is in there? Did you see that? And I was just sort of wondering, if Exxon is the answer, what is the question?
At least in terms of transition, right? Yeah.
Well, maybe you could help me understand that one. I don't know. No one from Blackrock here to answer that. So,
no.
So maybe we're just being a bit unfair. But, I'm not saying it's a greenwash. It's just we have got to get our questions right. And I don't see Exxon as being the answer to the energy transition, well, at least not at the moment.
Yeah. No, I think there's a bunch of that sort of thing going on, right? And there's even more subtle versions of that. Like, even if you take the ones that exclude fossil fuels, they call themselves ESG, and maybe they are, but then they charge higher fees because they're no longer passive. But then all they do is buy, Google, Apple, Amazon, and are purely passive, except for not having Exxon. So, both are interesting, and we need to think about what the implications are. And we need good people out there kind of holding their feet to the fire to point these things out. And we need to reprice risk in a radical way, and suffer the consequences of that repricing of risk, which will be pretty big, as you pointed out. All right, so we have questions from the audience. One is, what do you think of carbon credits? Are they a distraction, or worse, a perverse incentive to justify continuing to burn fossil fuels? Well, I don't know if anybody wants to tackle that, but I'll just say that I think carbon credits are useful. and an important part of what we need to do. I see them as a way to actually help price in that externality of carbon. And I think what people forget when they look at carbon credits is that there's a couple of things they forget. One of them is that there's two sides of a ledger of any carbon credit transaction. One side of the ledger is the one that's buying the carbon credits. And on that side of the ledger, we need to come up with the sort of standards that I think Lila was pointing towards, of saying, how do we measure scope 1, scope 2, scope 3 emissions? What are you claiming? And are you following what's known as the mitigation hierarchy, which is to say, first, avoid any emissions you can avoid. Second, reduce any emissions you can't avoid. And third, only as the last resort, buy offsets. And I think having the offsets to put a price on carbon sends that important signal to the market that emitting carbon has a cost. And so I think they're useful. I think, we need good standards on both sides of the ledger, also good standards on the side of the ledger of what constitutes a carbon credit. Is it real? Is it additional? Is it verifiable? Things like, Vera, VCS, or ACR, or CAR, or all of these institutions have come up with standards that have evolved over the years. And, we can criticize them, we can make them better, but I think we're going to see a lot more of them, in particular with these net zero commitments, because I think there's going to be demand for sure.
And Ricardo, I would just add that we really need to harmonize what's going on between the US and the EU in terms of those carbon disclosures, so that we can get a realistic price.
Can I add to, or at least maybe disagree a little bit with Ricardo, in the sense that yes, they can be useful and important, but we have to acknowledge that the track record on credits and offsets is pretty checkered. That the social science literature on this, the research on additionality, does not make for happy reading at all. That many of the credits have a really bad history, and so there is, I think, an onus on credit markets to prove that they are really going to deliver on environmental benefits.
Yeah, I would disagree with you that the majority are bad. I think, we had a run in the first version of the carbon markets where there were a lot of CFC credits from China and other places where they weren't up to snuff. Yeah. I think nowadays, some of those standards are actually quite good. And, I've seen some hatchet jobs in the press and in the social science literature which fail to understand how the standards work on additionality and fail to take into account why the standards are the way they are on additionality. I think it's a nuanced discussion, but I think there's a lot of people coming into this without really having the history of how these things evolved and why they evolved the way they did. And I've seen many, many more good carbon projects than I've seen bad carbon projects, to be honest with you. But that's just, my take, and reasonable minds can disagree. All right, so the next one, how do companies think about verifiable, auditable carbon reduction tracking on a standardized basis? Without regulation, SEC, New York, et cetera, no one is really sure how much carbon reduction they are achieving. Interested in any views on this? I don't know, Rodrigo, you must come across this a lot at Amazon. What are you guys following in measuring your both emissions and reductions? What sort of standards are you looking at?
We publish our reports and have an outside auditor that verifies our accounting. I can't remember the exact auditor that we use, but we have a deep, internally built, robust accounting process. And then we make choices about at what granularity we obviously publish to the public what we're doing, but we also publish our progress against that net zero 2040 goal. So we are open about when emissions go up and when emissions come down. So far, the last year, the first year-over-year cycle, our emissions went up. And it's part of our challenge, but we're committed to being transparent about it, and we'll continue to follow sort of the best practices of it. So it's not we're not both publisher and auditor of our own information. I just can't remember at the moment who our third-party auditor is.
Yeah, I mean, the original protocols were the GHG protocol, and now we're seeing the Science-Based Targets Initiative kind of trying to come to grips with how these things are measured and monitored.
And we've signed up to that science-based target, that science-based initiative. So the climate pledge is, again, it's not an Amazon initiative. It's actually an initiative started by Global Optimism, which is led by Cristina Figueres. And so we are signatory. We're the initial signatory to it, but we've also been working to bring more companies into the climate pledge. And then another initiative that we've joined is the Science-Based Targets Initiative.
Yeah, I'll just add that we have both kind of initial supporters of the climate pledge and then trying to help our companies. Again, I think, we have been advocates of disclosure through CDP since we helped kind of CDP come into the ecosystem with people like Mark and others. But to a certain extent, there is now a whole ecosystem of service providers, support auditors like this. There is actually a maturation of the capability set such that any company that truly wants to move to setting science-based targets, going through the TCFD, scenario analysis, there is, you could call any one of us on this Zoom and we could help you within one click get to the person who could help. So I think this, it's not we don't know how to do it anymore. It's just has this gone to your board? Has your board signed off that this is a strategic imperative? If so, proceed to go. And I think there's now less friction in proceeding to go. So it's probably the boardroom conversations that are still, cycling.
I know Mark answered a question from Daniel Ferger, but I think it's an interesting one to hear a little bit about. It says, "Thank you all." At Mark, could you discuss briefly what you think would change in capital formation allocation if your big new idea, a global carbon registry, were to come to pass? Maybe can you tell us a little bit about that global carbon registry and what you think about it?
Yeah, okay. Well, I wrote about it in last week's Financial Times. If any of you sort of read my op-ed in there, I think with the global registry, what it is actually, it's a registry of CO2, of embedded CO2, so that as projects get through approval process and bring production on stream, and as governments announce new licensing rounds, and new permits for coal, you can calculate the cumulative carbon dioxide in the reserves that sit there. And so it'd be like a running clock down to 1.5 degrees and then through to 1.75 through to 2. And as we know, we've already got enough proven reserves to take us way beyond 3-4 degrees. If you can find it on Carbon Tracker's website, we wrote to FASB, the Financial Accounting Standards Board, in 2013, asking the commissioners, or whatever they're called, to consider whether US fossil fuel companies should disclose the embedded CO2 in their reserves. And it got put to the vote, and we lost 7-0. None of the regulators thought that this was information that was at all relevant. Goes back to the point you were saying earlier about the SEC. I wonder if we tried it again, whether FASB would let it through this time, but who knows? So we think this element is the crucial.
It was rigged, Mark. It was all rigged. Voting machines.
Yeah, I mean, we think this element is vital, but those who are familiar with the global registry idea, it's actually linked to something called the Fossil Fuel Nonproliferation Treaty. If you go to a website, fossilfueltreaty.org, it's an initiative between the global south and the global north to essentially get governments to agree together. I mean, the issue I've seen in my work is that every country wants to be the last man standing. Of course, Alaska and the shale plays in the US want to be producing for another 30, 40 years. Of course, Canada wants to develop all its oil sands. Norway wants to develop everything in the Arctic. Argentina wants to develop Vaca Muerta. Everyone wants to be the last man. What they want is everyone else to give up their production. And so if you think it through, the game theory, for everyone to win, if you want to constrain the supply of carbon, everyone has to agree to lose by giving up their production rights through some kind of international negotiation. And we've got a big international announcement tomorrow about global support that's going to be announced tomorrow about support for the treaty idea. It's essentially to change the debate. I mean, if anyone's familiar with the Paris Climate Agreement, there's 3 words that don't appear anywhere in it, and that is coal, oil, and gas. The climate agreement, as everyone knows, is an emissions reduction agreement. It pledges countries to reduce their emissions, doesn't pledge countries to cut the production and use of fossil fuels. It pledges the reduction in emissions. And that depends on the actions of thousands and millions of actors, corporations like Amazon, but also governments and individuals, us as consumers. But if you think about fossil fuel supply, about 100 countries and corporations produce most of the world's fossil fuels. And it's far easier to get an agreement with 100 people to cut production than it is to change the behaviors of billions of people, which is what is really required under the Paris Agreement. So it's an attempt to change the framing of the debate. How will finance react? You impose a cap or a cut, then markets will react and price accordingly, or you'll create scarcity and constraints, and hopefully it will lift up the energy transition and renewables and dampen down Wall Street's continued still enthusiasm for funding, fracking and Canadian oil sands and so
on. All right. Oh, there's a question about Bitcoin. We should have seen that one coming. It says Wall Street Journal said for every billion that goes into Bitcoin, that's like adding 1.2 million cars. How can that carbon imprint be neutralized or limited? Anybody? I'll take a running stab at this and probably stab myself, but I think what we're going to see is we're going to see the movement of some of these cryptocurrencies to what's known as a proof of stake rather than a proof of work. And a lot of the energy emissions in these things come from proof of work. So having lots of computers solving basically math equations. And a proof of stake is quite different. And we're seeing Ethereum move to a proof of stake. But that doesn't change the fact that Bitcoin is probably going to continue to be a proof of work, at least for the foreseeable future. And that's the big one. And that's the one that's really, hogging up energy. I think if you talk to the sort of Bitcoin maximalists, the solution is, put lots of renewable energy in places that can't usefully use renewable energy and hydro right now, because, you don't need to transmit it across to somebody else. It can all be used in Bitcoin farms. And so, that's the solution. Whether we'll actually get there, highly doubtful when you see that most of the processing power being done for Bitcoin is in China, and you're probably using coal. So, I don't know how to solve this. I think it's a pretty big problem, particularly the way things are going with Bitcoin.
I just was going to, on this build, that there's a reason why taking a system view is really important. So you can't assume sort of one good and not think through the consequences. I mean, just, all of our data needs equally, are, if not paired with a massive transition in our energy production system, are going to be equally onerous, maybe not quite as Bitcoin onerous, but I'm sure Rodrigo would have a thing or two to say about kind of like data center greening, because that's going to be critical for all the big tech companies. But, having these conversations linked together on positives and then what are the knock-on consequences that we have to think through, because there is that whole layer of just like base infrastructure that at all country levels will have to be modernized. I think finally we're getting to at least a philosophy of modernization of infrastructure here in this country that's like potentially overdue, that's going to be in tandem with some of these innovative and exciting new trends on digital disruption.
All right. Two questions that I'm going to kind of merge together. One is, where do you think is the most efficient balance of regulation and free market forces to meet the 50% CO2 reduction by 2030? And then another one that sort of says, isn't capitalism and our relationship to nature the fundamental issue here? Anybody can take any of those if you want. Nobody?
On the first one, I think, as I mentioned in some of my opening comments, I think a really good nexus to continue to pay attention to this trend on this 50% trend is, again, I think there's a massive cost reduction that's going to continue to come down on wind, solar, and batteries, just to begin with. I think there will be other sources of renewables that will be widely spread. I think we're going to see more diverse sources of hydroelectricity that's not sort of massive dam building hydroelectricity. And I think we're also going to see more geothermal electricity, possibly maybe a comeback of more activity around ocean energy. I haven't been following that as closely. But all of this, I think, and the fact that these assets are being, or these projects are being, there's an increasing trend to those being built as merchant plants, is a real indicator that the project developer has the confidence that they're going to find electricity markets for those electrons when those systems start producing. And that, again, is another evolution on, it used to be that as a developer, you didn't take that extra risk until you had that contract on the other end, the power purchase agreement. Those power purchase agreements are still important. There's more liquidity and visibility into those power purchase agreements. There's interesting platforms that are facilitating more access to those power purchase agreements. But I think another interesting trend is the developers that are willing to create more projects as merchant projects. And that to me is a really interesting trend, because they're saying we are confident that these electrons will find a market, even if we can't contract it today.
Mm. Yeah, I mean, sorry, Julie, did you want to jump in?
No, finish your thought.
No, I was just gonna, say, I think personally, I think, like Winston Churchill, that capitalism is the worst of all possible systems except for all the others, right? And in many ways, I do think that it has given us a lot, and that there is a tremendous amount of important things that capitalism delivers, which is about managing resources. I think the biggest problem I see is, again, going back to beating that dead horse of the environmental externalities, that the capitalist system was created at a very different era, when what was scarce was capital and labor, not natural resources. And so I think we had a blind spot for the natural resources. I think we have a blind spot for ecosystem services. So when, a capitalist, quote unquote, is looking at their books, they're not seeing the whole picture. They're not seeing the losses that come from cutting down a forest. All they see is the gains that come from the wood. And until our system, patches that blind spot or changes the system, I think we're going to have all kinds of problems, including the fact that fossil fuels are worth the way they're worth. And, there's a whole lot of reasons for it that includes subsidies and government and, regulatory problems and regulatory capture by business, et cetera. But part of the reason is that we weren't for many years seeing the side effects of that and the problems there. And it may mean not a patch, it may mean a completely new operating system, because that's what this is. This is our operating system for how the world works. And honestly, we're running Windows 95 in a world of Twitter, Clubhouse, Facebook, and Instagram, and it's not holding up. And it's not even Windows 1995, it's Windows 1795. So, we need a complete reboot, I think. But I still think we can't throw out the baby with the bathwater there. All right. Yeah, go ahead.
I mean, that's very well said, Ricardo. I don't want to cut off Julie if she wanted to jump in.
No, I was going exactly in that direction, in that it isn't so much capitalism's problem with our relationship with nature or the nature of capitalism. And I think we need to keep that in mind. You're absolutely right, Ricardo. We need a reset. Capitalism was not founded with the intention, I don't believe, of ruining our planet. But here we are. and we need to redo, as Lila said, we need to look at it in a systemic way.
I would just say that when you think about the political movements on this, there really are, especially on the progressive left, kind of two different theories of change in operation simultaneously, where you have some folks who think that not just our emissions need to change, but sort of all of society needs to change, or at least a large part of the capitalist underpinnings of our society need to change. Versus a more, so that's the sort of revolutionary folk versus the more sort of reformist approach that I don't want to put words in his mouth, but I interpret Ricardo as saying, and I think that if you think about the kind of the long history of the development of capitalism, it is scary if we need to revolutionize capitalism fully to make any progress on climate change, because that's going to take a very long time. This does not get developed in a year or a decade or anything like that. So I hope that we can, as you say, update our operating system in a big hurry, but limit the degree to which we need, I don't know what the analogy is, hardware changes or something like that, or much more
backup before you upgrade. Mark, did you want to jump in here?
What fossil fuel capitalism does very well, as it does throughout a system, is it concentrates wealth and power and privilege in the hands of the few against the interests of the many, and it does it very effectively. So we have a system where 80% of the world's population live in energy importing countries, and under a fossil fuel system, you have pretty much a monopolistic, certainly, the last, maybe the last 100 years up until 5 years ago, to get from A to B, you needed an internal combustion engine that ran on a fuel that came from, whether from the Middle East or from some large corporations. And if it cost them $20 to get it out of the ground and they could sell it for $80, that was what corporations could do. And then capital flowed into the hands of an oligopoly or an elite in some not particularly nice countries, whether it's Saudi Arabia or Venezuela or Saudi Arabia, of any political persuasion. What I see happening with the clean energy transition is actually huge disruption of this kind of traditional fossil fuel capitalism, because instead people will be able to generate power at the household level, at the village level, in rural areas, and you won't need to be shifting tankers carrying petroleum products across the world, whether it's LNG or gasoline or whatever. Actually, you could generate electricity off the roof of your building. You could have a battery storage. You can, and so actually the clean energy revolution will be a fundamental disruptor to this form of oligopoly. Because if you look at the 8 of the 10 of the world's largest sovereign wealth funds, they're all based in fossil fuels. And you've got these huge concentrations of power. All of that's going to get swept away with the renewable energy revolution. We'll bring a form of democracy, because countries, particularly in Africa and Asia, they're having to earn dollars from selling commodities, whether it's coffee or tea or labored products, to earn petrodollars to import fossil fuels in dollars. That will all disappear. And those scarce dollars that they're earning can go to things like pharmaceuticals and vaccines and education. So you said I'm a pessimist. I'm a huge optimist, actually, that we'll be alive in this next decade to see the transformation of a political transformation. The thing is, and I'm nicking this from one of Julie's colleagues at BNP, Mark Lewis, is fossil fuels are inherently inflationary. You have to dig them out of the ground, transport them halfway around the world, whether through, you have to decompress the gas to liquefy it and then recompress it, and to get it to burn in a power station, then you have to take the CO2 out. Hugely costly, whereas renewables is inherently deflationary. It's free, it's all around us, the wind, the sun. You just have to capture it, and it just gets cheaper and cheaper and cheaper. And I think it's that form of crisis, I think, that the fossil fuel capitalism will face, that will be its ultimate death knell, because it's losing because of competition, and that we'll see what it gets swept away. So one of the good things of capitalism is its competitiveness, and it will actually be the thing that it protected the system of the last 100 years will be the thing that destroys it in the next decade.
I know some of you have to leave, and I appreciate that. That's a hopeful note from Mark to end.
Oh yeah, I'm supposed to be going to bed now. It's really late in London.
It's really late there. But look, I am happy to stay on as long as there's people that want to talk about this. So
I'm surprised you've not suggested we switch to Clubhouse, Ricardo.
We can if you want.
That's where I normally see you.
I can if you want, but we have a couple of more questions. I'm happy to take them. I know Rodrigo has to jump. Thank you so much, Rodrigo. We really appreciate you taking time to talk to us today. Here's what we'll do.
Thanks.
Anybody who needs to jump, thank you so much for joining. Really appreciate it. And I'm happy to stay with any of the diehards to try and answer the questions as much as possible. You're totally excused, Mark. You've given us a nice ringing sort of Jeremiah.
Look, thanks for involving a Brett. Things aren't so bad this side of the pond. We still have things like the royal family and stuff like that, but we're still trying to mix that kind of thing.
And you have a thing or two to teach us about the end of empire, so I'll go.
Yeah, and also soccer as well, Ricardo, which we managed to keep off for the last day and a half. But we can do that one on Clubhouse. Hey, Lila, great seeing you. Lovely seeing everybody. So
thanks, Mark,
thanks for including me. Bye-bye.
Bye, Mark. I have to feed some children, so I'm also going to have to run, but I'm really grateful, Ricardo. Happy if there's any. I thought that was a good place for kind of like the optimism message to land.
Yeah. No, I mean, jump when you need to, Lila. I'm just going to keep working through the questions because I think there's a bunch there. And if anybody wants to stay with me, they're welcome to. And if not, you're also welcome to jump. And I don't know when media services is going to turn us off, but I will continue until I get turned off.
Thanks, Ricardo. Thanks for including me. I'm going to head off. Bye.
All right.
Take care. I'm going to stick around.
Jeff, it's to me. Are you up for it? Or are you?
I'm up for it. Let's do it.
All right. Too bad we lost Julie. When will we see a major bank announce that they will discontinue oil and gas lending and advisory by a set future date? I'm hopeful that date will come. I think, it's interesting what BNP did isn't quite that, but it is a step in that direction. And I honestly, if you'd asked me, 5 years ago, would we ever see a bank take that step, the step that BNP took? I would have said no. So I think this is a very different time than the one we were living in even 10 years ago. I think that recognition of what Mark was talking about has changed radically.
Yeah, fully agree. Hard to be able to pin a date on like when that's going to happen, but I agree that the tipping point seems to be happening right around now.
Cool. All right. Policies allow for more streamlined action, but how do we begin to reward social and environmental value over cold, hard cash in the financial sector? Carbon credits seem to be an adaptation to climate change, but for a sustainable financial sector to do the quote right things, what needs to happen? It seems the financial market incentives are not well aligned to maximize social and environmental value over financial. I've kind of said my piece on the need for externalities to be incorporated, but I do think we are seeing some encouraging signs on all those fronts, right? With the ESG regulation that we spoke of, with carbon markets changing and growing and being implemented through cap and trade regulated carbon markets. I think we're going to see more and more of that, and the financial sector is responding. So, again, 15 years ago, you would have told me Larry Fink was leading the charge on climate disclosure. I wouldn't have believed you, and here we are.
Yeah, I think that, I don't want to be pessimistic about this, but I think you have to recognize the reality of what the finance sector really is there to do. Is that they're not likely to ever see it in their core interest to go much beyond making money and returning profits. That's what they're there to do, and so it's actually on us, meaning those outside of the finance sector, to push and nudge and pull them in the direction we want them to go. And that means regulatory power, it means policies, it means potential carbon pricing, it means consumer pressure, it means reputational factors. So it's sort of a whole basket of things that we can and should be doing. And I think to a certain extent we are starting to do, although of course I would like to see the pace of that move faster and harder. But that's where the leverage is, I think, in terms of changing where assets are allocated.
Yeah, I think any change we're likely to see is a complex dance between, policy, money, and consumer behavior and consumer drive. And I think what we've seen is at one point one leads, at another point another leads, and they've sort of changed around over time, and one brings the other and the other brings the other. And it's been fascinating to watch, because I do think, we're seeing some of this ESG growth, partly because we are also seeing one of the biggest transfers of wealth from one generation to the next. And that new generation is asking different things of its wealth managers. It's saying, no, I want you to find me, ESG options. I want you to find me sustainable options. I want to have an impact on A, B, or C. And that demand from the customers of finance is pushing the banks. It's the reason why Goldman Sachs, Morgan Stanley, JP Morgan, all of them have, sustainable finance divisions, departments, or what have you, because there is the demand for it. So I think demand plays an incredibly important role. And I think regulation is coming, and it's also following demand, but it's also following the money, but it's also following policy. So, it's a fascinating thing to watch. All right, my friend JP Dahlman says, using the context provided by Mark and the solutions finding approach by most in the panel, how do we accelerate and scale real sustainable and impact investment beyond ESG? This one's a tough one. I mean, I think we are seeing it scale, because I think we are seeing the bigger asset managers sort of begin to play in this space, Blackrock being the big indication. I think where we have yet to see the transformation is in institutional investors like the pension funds and the insurance funds and the sovereign wealth funds that Mark mentioned. I think the sovereign wealth funds, apart from Norway, are fossil fuel based. So it's going to be interesting to watch what they do. Well, Norway's is fossil fuel based, but they are also, investing in anti-fossil fuels and more renewables, which is interesting. But the insurance industry and the pension funds, I think what's happened with them is that they haven't seen the type of product they like, right? They like it when it's boring, when it's straightforward, and when they can invest not $10 million but $100 million a pop or more, right? They can't invest in small check sizes. They need big check sizes. Yeah. And I don't think they've seen the product yet. I think we're starting to see the product, and it's going to be first in the form of ETFs, exchange traded funds like the ones Blackrock and others are setting up. And as we see more of that product, it'll be interesting. I think the green bond movements and the sustainability linked bonds may be the way that brings in some of these institutional investors. And that's when we start to get scale, and that's when we start to see traction. And it's in their interest. They're universal owners. And, in a bad world of the future, they suffer as much as anybody else. So they should be investing in the better world, and they're long-term, right? They're trying to invest to meet liabilities 30 years into the future. They should be investing to maintain the things 30 years into the future, at least the pension funds. So
I would just add two very quick things. One is just recognizing that, what's happening in sustainable investment and ESG is, very much a Europe-led thing, right? Europe is like by far the largest part of the flows and is way ahead in terms of the, policies and standards and whatnot. And so to the extent that the United States can learn from that, I think that we should, North America, East Asia, et cetera, and to the extent that that sort of diffuses outward from Europe to other financial markets, that will scale up the whole thing, because as Ricardo says, things that are not really possible when it's like, $10 million loans suddenly become possible when it's $100 million loans or bigger ones. And then just so that was my point number one, and now I'm forgetting point number two. So forget that. I'll come back to it.
Yeah, no, I mean, it's been interesting to watch because we are seeing things like IFRS, the International Financial Regulatory Standards group, which includes, the SEC equivalents from around the world. Definitely, we've seen Europe and now New Zealand lead in terms of some of these regulations. But Singapore has instituted the same type of thing. We're seeing a lot of other countries do this. I think we're going to see something along these lines in the US. I was fascinated to see that article I mentioned by Hester Pierce, an SEC member, a commissioner, kind of saying, maybe we shouldn't move so quickly on this and maybe we shouldn't follow the Europeans. So there are a little bit of battle lines being drawn in this country, and we will see how they pan out in the long run.
I remember now. I mean, the one other thing I would say is just that, I think there's so much potential in investments in things, not so much in, say, the solar and wind and renewables per se, but the electrical grid, right? Modernizing the grid really needs to happen. And that could well be, I mean, you can imagine that being just a public sector investment, but it could be a blended sector, a blended finance kind of approach. And not only is that, a big project on its own, right? Billions of dollars involved there, but it can be kind of catalytic investment where you're then opening up new possibilities, because the grid that we have today that we've inherited from the past is not built for renewables. And so if we build one that actually is built for renewables, you get, a much bigger potential for that kind of grid, for that kind of power system. And that's really exciting. That's, to me, is where the optimism lies, is that there is that potential, and we should stop having grids where Texas can be its own grid and not be integrated whatsoever with the rest of the country, because we see how that plays out, right? It doesn't end.
Don't mess with Texas, Jeff.
Gosh. So that's the thought.
Yeah, no, I totally agree with you. And I think we're going to see these discussions play out with a new infrastructure bill, because pieces of it look a lot like, what we would want from a new climate energy policy or a Green New Deal or what have you. And those are the pieces that are likely to be hard fought in the political arena. So it'll be interesting to see what the battle lines look like around, modernizing the grid for renewables or stuff like that. And we will see it through that infrastructure bill.
Interestingly, the debate has mostly been about what do we call infrastructure at this point? And, is it just liberal programs? Anyway, that's a whole other thing. But it's funny. I mean, when you say the battle lines, you're right in one sense, but there's also this sense that there's like the infrastructure bill right now is being contested not on those grounds at all. It's been about the definition of what infrastructure is and whether this is going to be a caring economy, and sort of it's not a climate-led conversation at all.
Awesome. All right. So Sonam Velani says, what do you think of the early stage climate tech VC space? There is a significant amount of capital, new funds starting almost every day. Are we in a bubble, just trying to see what works and can scale? Or is this a part of the process to truly transform our built environment? Yeah. Look, I think it's a little bit of both, honestly. I mean, I think overall in the economic system, we are a little bit in that phase of where things feel very frothy and bubbly. And, that's both a good thing and a bad thing. It's a good thing because there are a lot of funds floating around that are going to some interesting things, and some of those experiments will pay off. It's a bad thing because most of these bubbles do come to an end. And when it comes to an end, it'll be fascinating to see what happens when it comes to an end, and how and what survives the bursting of that bubble. But it is the process we need to be in to transform our built environment. And it's part of the process. The other part is going to be policy and consumer demand. That's what's going to shift our built environment. That's the way I look at it.
I think that's exactly right. Don't have anything to add. It is a bit of both, for sure.
Yeah. Okay, John Anderson says, please comment on the need for a government putting an effective price on carbon, tax at the source of carbon extraction globally to help drive transition throughout the markets. Apologies if this has been addressed as I joined late. Look, I think a price on carbon is fundamental. It's essential. It's part of what, this internalizing that particular externality. I think there are lots of ways that that price is going to show up. I think it's going to show up in supply chains. I think it's going to show up in the form of a tax. And we're already seeing that in some countries. I think it's going to show up in the form of carbon markets and carbon offset markets and regulated carbon markets. And we're seeing that in a lot of places as well. And I am not of the belief that it's one or the other. I am of the belief that we're going to use both these tools and they have different characteristics. The way I think about it is that a tax gives you certainty of price without certainty of outcome. A cap and trade or a carbon market gives you more certainty of outcome without certainty of price. So it says, we're going to set a cap, we're going to limit emissions, and this is what we want to hit. And the price is going to be what the price is. Tax says, I'm going to charge you $50 a ton. And that may be too much or too little, and we don't know where it's going to end up. And then it becomes kind of ossified and is difficult to change because tax A is difficult to implement and B is difficult to change once implemented. So they have different characteristics. I think we'll probably need both. I am really excited to see what's happening in terms of cross-border tax adjustments. So some countries that have taxes are now imposing adjustments on imports that are high carbon, saying, you're coming from a place that doesn't have a tax or doesn't have a regulation. How are we going to adjust the price accordingly? And I think we're going to see more of that.
I would agree with what Ricardo just said, and very much, of course, it is an advisable policy. We would like this policy. In truth, I am more, pessimistic about its political prospects in the United States, that I don't think carbon tax is likely, at least in the near future. But what makes me really, my head spin right now is trying to think about carbon tariffs, right? So these border adjustments that the US might want to pursue even in the absence of a carbon price, or at least a universal carbon price. And that gets really interesting. Like, how could that be done in a way that is in sort of economically coherent way? And how would you measure it? How would you do it? Because it seems clear, actually. I mean, if you follow Biden's statements on this, he's big on carbon tariffs. He wants that for the United States, but he doesn't say anything about carbon pricing, and he hasn't been pushing on that. And so I think some hard thinking about, how do we do this in a coherent way is where I want to go next, actually, in my own thinking.
Yeah, I think that it would be fascinating to see something along those lines, and I think it's eminently possible and doable, particularly since we have seen tariffs for a lot of other reasons, and maybe this gets you a twofer. It'll be fascinating to watch how the pricing of carbon pans out in different countries. The World Bank has a fascinating report basically on the pricing of carbon, and looks at taxes around the world, and it looks at markets around the world. And it's a good overview of how it's developing. And the short answer is there is no global entity capable of doing one global tax, as you suggest, but what you're seeing is lots of little entities putting their own little spin on things, and then how these get adjusted, that's where it becomes interesting. I do think we will see a global voluntary market of carbon, which will be fascinating to watch as well, because it'll put a different type of price on carbon, and how that develops will be fascinating. All right, Reagan Smurthwaite says, is there any sign that the non-renewable energy companies are pressuring governments or utility districts to produce more renewable energy so that companies can purchase a higher proportion of renewable energy? I mean, apart from the Patagonias of the world and others who have said they're going to produce all renewables. And I think we had an announcement today on Amazon on the size of their renewable energy, kind of portfolio. So I think that pull is there. It's definitely happening.
Universities are the other bigger actor on this, right? So Brown, Princeton, and a bunch of other universities just recently, like in the last couple of weeks, have all been, announcing their kind of net zero plans. And a lot of those involve scaling up renewables. And so that's worth paying attention to as well.
Yeah, so I think we're going to see a lot more of that pull, and I think we're going to even see some countries putting renewable energy targets as well. I think the price of renewables just makes all of this transformation really, really possible in a way it wasn't before. Oh, look, JP Dahlman has been sharing this on Clubhouse. So we were virtually on Clubhouse, Jeff. What do you know? Thank you, JP. Really appreciate that. And thanks for your kind comments. Okay, what about adaptation? Is finance stepping up there, or isn't there a business case yet? I haven't seen specific cases of finance stepping up to adaptation. I have seen, people building it into their plans of sort of saying, look, we're going to have to spend for seawalls, we're going to have to raise houses. I think that is starting to filter in as a cost. And that's where I think a lot of adaptation is going to filter in. It's going to be a risk and a cost. And the more businesses, particularly insurers and others, build that into their models and build that into the economic modeling, the better that will turn out. I do see governments and municipalities starting to think this way on how to finance adaptation. And I think a lot of them are turning to some of these bonds and other measures to finance it. Ultimately, though, those come from tax revenues usually. So it'll be standard old tax revenues, but maybe some of them will use green bonds or sustainability linked bonds or other things like that to finance that adaptation.
Yeah, I don't follow this stuff, but it does seem like the municipal bond market is the place to look for where, and how adaptation is being financed.
Yeah, I think that's absolutely right. All right. What do you think about the role of multilateral development banks? Are they part of the problem or part of the solution?
So I think they've been both, is the truth, but they are increasingly taking their role as being part of the solution quite seriously. That I think they are, trying to move away from the historically sort of dirty energy products that they have financed, and help not only with finance but also with technical capacity, but how to do things in places where there often isn't a lot of technical capacity, so I think there is something there. But I will say just another kind of interest of mine is in the kind of competitive development finance space. And I mean competitive in the sense that, the Chinese have one model for development finance and the Western world has a slightly different model. And those are coexisting relatively happily these days, but it isn't guaranteed to be thus forever. And so, obviously the Belt and Road Initiative is backing an awful lot of fossil fuel-led development. And so there's a real question here about how much that continues in the future. It's great to see Japan and Korea say, no more coal, we're not going to do that in their development financing. They haven't quite lived up to it just yet, but they've at least said it. It's unclear how much China says, multiple things about it, and they're not too clear about it. So that's one to keep an eye on.
Yeah, absolutely. China is the big gorilla in the room in terms of how it spends its money and where it's spending it and how that develops. I think it's going to be really interesting to watch. I mean, I think the traditional ones, the World Bank, the IFC, and others have been wrestling with this problem for quite some time and, have set standards. I think I would probably argue some of them don't go far enough in terms of what they finance and what they don't finance. So I think to some degree they have been part of the problem. I think they're trying not to be. I just don't think they've gotten there yet. I would say that they have a ton of really interesting initiatives and provide, technical assistance and other capital through things like the GEF or others, or even the bilaterals, sort of, USAID, DEFRA, DPI, all those guys, have been putting a ton of money into some of these interesting projects to reduce emissions. And the World Bank was a key player in the early days of the carbon markets, had the first carbon fund ever made, continues to track that and monitor pricing. So yeah, I think Jeff's absolutely right. They have been both a problem and part of the solution, and hopefully that balance will tilt more towards the solution side in the years to come. All right, Ken Pucker, notwithstanding the reported levels of ESG investment, anywhere from 1 trillion to 80 trillion, I do not see evidence that ESG investment, as distinct from climate tech, is having any influence on E and S outcomes. Do you? Look, I think it is. I think absolutely. I think the disclosure of this information leads to all kinds of ripple effects. So those ripple effects include, asset managers asking companies, well, what are you doing? Well, how much are you emitting? Well, can you reduce that? Now I'm having problems because you're emitting. So, I do think that has changed things. I also think we've seen an incredible amount of impact investment and investment in environment that wasn't there before, that is driven by this push towards ESG. So I do think it is having a difference even beyond climate tech. And it's addressing things that climate tech isn't, right? It is getting into municipal infrastructure and water systems and things that may not be as sexy as a Tesla or solar energy, but that are just as important to build out the infrastructure we need for that future. So I think it is making a difference. And I do think the social side, is farther behind in some ways, partly because I think the E has been easier to measure in terms of like, how many tons are you emitting? S outcomes, I think, are more complex and complicated, but people are starting to wrestle with them. And there's this whole initiative around human capital. How do you value human capital? Because just like there's been a natural capital externality, there's a human capital externality in the market that needs to be dealt with. And I'm seeing lots of interesting and exciting initiatives around both the E and the S. And the G too. So I would disagree. I think it is having an influence.
Yeah, I think that, we're right to be skeptical about this, and that there is greenwashing happening here, right? So there is some combination of both greenwashing and real action. But the story I kind of like as a positive story on this is, Apple is getting all kinds of pressure from its consumers and its investors to clean up its supply chain. So they go to Sony and say, Sony, if you're going to be one of our suppliers, you need to have, more renewable energy. And Sony turns around and goes to the government of Japan and says, our electrical grid is a mess. We need renewables. What's the plan here? And suddenly the government of Japan is thinking, gosh, we really need to work on this. And so that's the kind of like, domino effect, I guess, that gives me a little bit of hope that this isn't all just, just fluff and talk. And so even as we keep our kind of skeptical lens on, look for those positive stories as well.
Great. And the last one, and thanks for staying with me, Jeff, on this marathon. Public climate finance institutions, GCF, CIF, want to engage the private finance sector in investing in renewable energy, energy efficiency, and climate resilience mitigation and adaptation. Is this a misplaced goal, given the incentive structures that private finance face?
Wow, I'm gonna let you take that one.
Yeah. No, I think it isn't a misplaced goal, because I think finance is really capital is an indication of what we as a society value, and until we get a huge amount of that money flowing, as Mark was saying, away from the fossil fuels that we don't want into other sectors, whether it's renewable energy or even green infrastructure or other things on the ground, then I don't think we're going to get to where we need to get to. And so I think having some of these public finance institutions thinking about how do we leverage the private sector, I think is incredibly important, because I think it can really change things. And I think we're going to see a lot more public-private partnerships at a bigger scale around climate, because at the end of the day, I think people are starting to realize that the public sector alone can't do this. The private sector alone can't do this. We had a bit of a clickbaity title sort of pitting finance against policy, but at the end of the day, everybody said, it's about both of them. Finance and policy go hand in hand. I think we're going to need to see them go much more hand in hand in the future, and I think we will.
Yes, what Ricardo said.
Great. Well, Jeff, thanks for hanging out, and thanks to all of you who stayed to the bitter end. Really appreciate it. And thanks in absentia to the rest of our panelists. They did a tremendous job, and this is a fascinating discussion that I know some of us could spend hours and hours on, but thanks to Brown for hosting it, and hopefully we'll see you at a future event of the various Brown entities, Institute of Brown, Environment and Society, and the Climate Solutions Lab. I'm sure we'll be doing more cool things around this too, right, Jeff?
I sure hope so. Thank you so much, Ricardo. You've been a tremendous organizer and moderator, so and a wealth of information too. So thank you.
All right. Take care, everyone.
Sure.
Bye-bye.